Tax season is always just around the corner. And even for those of us who think we have a handle on it, the rules, they can feel like a maze.
Especially around dependents and filing status.
Exactly. If you're a U.S. citizen or resident, you know the rules apply to your worldwide income, and, well, the complexity is real. But our mission today is simple.
We're going to cut through it.
We're turning those dense tax documents into a clear guide, really getting you ready to master the 2025 filing fundamentals.
That's right. We're aiming for tactical knowledge here, so you can make informed decisions before you even start preparing your return. For this deep dive, we're focusing on, I'd say, 3 critical pillars of filing.
Okay.
First, we have to nail down the foundational tests for claiming any dependent. And that, it instantly splits into 2 camps, qualifying child versus qualifying relative.
Then we're shifting gears to look at status. We'll spend a good amount of time mastering the requirements for choosing the most beneficial filing status, especially the coveted head of household status.
And we'll touch on qualifying surviving spouse, too. A very important temporary benefit.
And finally,
we'll break down the crucial income thresholds and some of the, well, surprising, often hidden rules that determine when a taxpayer must file a return, even with very little income.
before we jump in, let's start with one absolute foundation nugget for 2025. This is key.
Yeah.
Taxpayers cannot deduct personal exemptions or exemptions for dependents anymore. That changed with the Tax Cuts and Jobs Act. So the reason claiming a dependent still matters so much isn't for a deduction.
Right. It's because claiming that person unlocks other massive tax benefits.
Specifically various tax credits and, of course, those favorable filing statuses we just mentioned.
It's all connected.
Okay, let's unpack this dependent puzzle. This is really the starting line for so many credits, like the child tax credit.
It is.
Before we even worry about age or student status or relationship, there are 2 non-negotiable gates. These must be met for any dependent claim, period.
If you fail either of these, the discussion just ends right there. These are the universal standards.
What's the first one?
The first is the dependent taxpayer test. The person you're trying to claim, they can't file a joint return with their spouse for the same tax year.
Okay.
Generally speaking, if they're married and filing jointly, you just can't claim them.
Simple enough. And the second gate deals with location.
Correct. That's the citizenship or residency test. The dependent has to be a U.S. citizen, a U.S. resident alien, a U.S. national, or a resident of Canada or Mexico for some part of the year.
So if they pass those 2 gates, then we hit the big split.
Yes. Then you have to figure out, is this person a qualifying child or are they a qualifying relative? And they absolutely cannot be both.
So this distinction is crucial. It leads to very different tests.
Very different. Especially when it comes to things like income and residency.
So let's start with qualifying child, the QC.
The qualifying child status, it usually seems pretty straightforward when we're talking about, your own minor children.
Yeah, you'd think so.
But the IRS still applies 4 really strict cumulative tests. You have to meet all of them.
Okay, what are they?
There's relationship, age, residency, and support.
Let's start with relationship. It's the obvious ones. Son, daughter, stepchild, foster child, sibling.
Right, half-sibling, step-sibling. But here's where people get surprised. It also includes a direct descendant of any of them.
Meaning your grandchild or your niece or nephew could meet this relationship test.
Exactly. Now, the age test is where students often create some complexity. The person has to be under age 19 or under age 24 if they were a full-time student for at least 5 calendar months of the year.
And there's an exception for disability.
A key one. If the person is permanently and totally disabled, their age doesn't matter at all.
The residency test is what trips up separating or divorced parents all the time. The child must have lived with you for more than half the year.
But what's often misunderstood is that temporary absences count as time living with you.
Like going away for college.
College, vacation, military service, even some medical care. That's a crucial break for parents whose kids are away at university. They still meet the test.
Okay, and the last one, support.
The support test. And this is important. It means the child did not provide more than half of their own support.
Ah, so the focus is on what the child provided for themselves, not how much I provided.
Precisely. If they supported themselves less than 50%, this test is met.
Now let's pivot to qualifying relative, the QR. This is where we see claims for, say, an elderly parent or an adult child who's not a student.
Right, or even other family members. And the tests are different. I'd argue they're more complex.
So what's the first one?
Well, first, They just can't be a qualifying child of any taxpayer. If someone else can claim them as a QC, you can't claim them as a QR.
And then comes the money.
Then we hit the major financial gate, the gross income test. And for 2025, the number is really specific. The person's gross income has to be less than $5,300 for the year.
$5,300, that's a hard limit. We should probably clarify what gross income means here.
We should. It includes all earned and unearned income. So, wages, interest, tips, taxable pensions, all of it.
And understanding the difference between taxable and non-taxable income is critical here.
Absolutely. Let's use an example. Say you're supporting your mother. She received $2,400 in Social Security benefits.
Okay.
And another $1,200 in a military pension that's non-taxable. She also had $800 in interest income from a savings account.
So her total cash flow is much higher than that $5,300 limit.
Right. But for tax purposes, only the $800 in interest counts toward the gross income threshold.
Yeah.
The Social Security and that specific pension are non-taxable.
So she passes the income test.
Easily. Since $800 is far less than the threshold, she's potentially eligible for you to claim her. You have to know what's taxable to apply this test correctly.
That's a perfect example. Okay, now the support test for a QR is much stricter than for a QC.
It is. For a qualifying relative, you must have provided more than half of that person's total support.
And that includes everything.
Everything. Food, clothing, medical care, education, recreation, and yeah, the big one, lodging costs.
That sounds complicated if, say, you and your siblings are all helping support an elderly parent. What if no single person hits that 50% mark?
That's a great question. And it's where Form 2120, the Multiple Support Declaration, can save the day.
How does that work?
If a group of people collectively contribute over half the support, but nobody individually pays more than half, they can agree to let one person claim the dependent.
But there are rules for that, I assume.
Of course, the person making the claim has to have paid more than 10% of the total support. And everyone else involved signs that form saying they won't claim the person. You attach it to your return.
So the IRS allows for a group effort as long as the paperwork is straight.
Exactly. It formalizes the arrangement.
Okay, finally, we have the relationship or member of household test.
And that distinction isn't minor. It's either or. They either have to meet a long list of specified family relationships, or the person must live with you all year as a member of your household.
All year. That's the key part.
It is. The relationship list is extensive: ancestors, siblings, step-parents, in-laws. For them, they don't necessarily have to live with you.
But if they're not on that list, say a partner or an adult cousin, then the all-year rule is the only way.
Precisely. Let's use the classic girlfriend example.
Yeah.
Say your partner lived with you for 6 months. She's a member of your household, yes, but she only qualifies as a QR if she lived with you for the entire year.
12 full months.
12 full months. That's the key. And one final nuance here. Relationships created by marriage, like a mother-in-law, are not removed by death or divorce.
So once an in-law, always an in-law for tax purposes.
That's right. That relationship test is locked in.
Okay, moving on. Choosing the right filing status is a massive factor. It impacts your tax rates, your standard deduction, your credits, everything.
It really does.
And head of household is a huge benefit. It offers lower tax rates and a much higher standard deduction than, say, single or married filing separately.
To qualify for head of household, you have to clear 3 hurdles. 1, you pay more than half the cost of keeping up the home. 2, you're unmarried or considered unmarried on the last day of the year.
And 3,
a qualifying person must live with you in that home for more than half the year.
The crucial element here is defining that qualifying person. Who can it be?
It's usually a qualifying child or a qualifying relative whom you can claim as a dependent. This is why those tests we just discussed are so foundational.
And here's where it all connects back. Let's use that non-relative example again. If your partner lived with you all year, and she met the gross income test, under $5,300, and the support test, you paid over half. She's your qualifying relative.
That's right. She is.
Which means she's also your qualifying person for filing status, so you qualify for head of household.
That's the critical link. HOH status can open up purely based on your ability to claim that person, even if they aren't related to you by blood or marriage.
And there's an important exception here for children, especially in divorce situations.
Right, it's the custodial parent.
A custodial parent can often claim HOH status even if they signed a declaration allowing the non-custodial parent to claim the child for the child tax credit.
It's a negotiated trade-off. You get the HOH benefit, your ex-spouse gets the child tax credit. It allows both parents to use favorable tax rules without double claiming.
Let's pivot to another status that offers temporary but very substantial relief: qualifying surviving spouse, QSS.
This is a crucial, high-impact status for anyone who has recently lost a spouse. The year of death is the last year you can file married filing jointly.
Okay.
QSS status can then be used for the 2 years immediately following the year of death. It basically lets you use the favorable tax brackets of married filing jointly for 2 more years.
So, an example. If someone's husband dies in 2025, she files MFJ in 2025. Then she can use QSS for 2026 and 2027.
Correct, provided she doesn't remarry during that time, and she has a child or stepchild she can claim as a dependent. And she still has to pay more than half the cost of keeping up the home.
It's a huge help while someone adjusts to filing as single.
A huge help.
So, when is filing mandatory? It seems like it's just about hitting a certain income level, but it's not always that simple.
It's not. The requirements are based on your gross income, your filing status, and your age.
If we look at the 2025 thresholds, they seem pretty logical. A single person under 65 must file if their income is $14,600 or more.
For married filing jointly, both under 65, it's $29,200. These numbers align roughly with the standard deduction amounts.
But here's the bizarre kicker, the one that catches everyone by surprise.
Married filing separately.
If you're married filing separately, you must file if your gross income is just $5.
$5.
$5? That's astonishingly low. Why? What is the IRS trying to prevent with a $5 threshold?
That rule isn't about collecting revenue. It's about regulatory control. It's designed to prevent double dipping on deductions.
How so?
If you file MFS and one spouse chooses to itemize their deductions, that forces the other spouse to also itemize. Or if they don't, their standard deduction becomes 0.
I see.
So if the non-itemizing spouse just didn't file, they could potentially try to claim the full standard deduction later, which is an incorrect tax benefit. The $5 threshold forces both parties to file so the rules are applied correctly.
So it's a check and balance mechanism, not an income threshold. That makes so much more sense.
Exactly.
And the rules are totally different for dependents filing their own returns.
Far more complex, but we can simplify the takeaway. There are basically 3 main triggers for a dependent to file.
Okay, scenario 1.
Investment income. If their unearned income like interest or dividends was more than $1,300, they must file.
Scenario 2.
High earned income. If their wages were more than $14,600, they must file.
And the third one is that confusing combination formula.
Right. Let's simplify that. It basically just means if their gross income is high enough to be taxable after their standard deduction, they must file.
Got it. But even if your income is below all these thresholds, you might still be required to file.
Yes, because of what you call the hidden triggers.
And they are vital for compliance? There are, 20 specific conditions that can mandate filing? You must file if you owe household employment taxes, for example.
Or if you receive distributions from a health savings account, an HSA, or advance payments of the premium tax credit for health insurance.
These triggers often have nothing to do with whether you owe tax.
It's about whether you participated in a specific program that needs reconciliation or reporting.
And the crucial tip here. Even if you don't have to file, you absolutely should file to get a refund of any withheld taxes.
Or to claim those valuable refundable credits. The Earned Income Credit, the EIC, and the Additional Child Tax Credit, the ACTC, are only accessible if you file a return.
So the incentive to file isn't just about compliance.
No, it's about leaving guaranteed money on the table if you don't. That shifts the whole perspective from a chore to an opportunity.
Okay, let's talk about the nuts and bolts, the paperwork. If you're a U.S. citizen or resident, you're using Form 1040.
Or Form 1040 SR if you're 65 or older. The current version of the 1040 uses what the IRS calls a building block approach.
Meaning the main form is shorter, but the complexity is just moved somewhere else.
Exactly. It's moved into mandatory attached schedules. You can't really complete the 1040 without looking at these building blocks.
So what are the key schedules?
You'll always see Schedules 1, 2, and 3. Schedule 1 handles additional income adjustments. Think unemployment, business losses, IRA contributions.
And Schedule 2?
That's additional taxes. This is where things like the alternative minimum tax live, or those household employment taxes.
And Schedule 3 is for credits and payments.
Yep. Education credits, the foreign tax credit, things like that. Beyond those, you get into the more common specific ones like Schedule A for itemized deductions or Schedule C for a business.
Speaking of mandatory requirements, let's talk about the TIN requirement, Taxpayer Identification Number.
Right. A return just isn't valid without one.
Right.
An SSN, ITIN, or ATIN for both the taxpayer and every single dependent.
The standard is the Social Security number, the SSN.
Right.
But what's an ITN?
The Individual Taxpayer Identification Number. It's for people who have to file but are ineligible for a Social Security number, like certain non-resident aliens or their dependents.
And it's important to note, ITNs do not authorize work or provide Social Security benefits, and there's a huge limitation.
A major one. A child with an ITIN cannot be a qualifying child for the Earned Income Credit. That's a big financial distinction.
And there's one quick, memorable detail on TN.
Ah, yes. The IRS allows you to claim a child who was born and died in the same tax year, even if they never got an SSN. You just enter the child's name and the word deceased on the form.
Finally, let's talk timing. When is income actually counted? Most of us use the calendar year and the cash method of accounting.
Under the cash method, you report income in the year you receive it. But this is where the legal concept of constructive receipt becomes crucial.
Let's use that photographer example. PJ, a photographer, shoots a portrait on December 31st, 2025, and gets a check for $500 dated that same day.
Because she had physical possession of that check, she had the right to cash it. That's 2025 income.
Even if she doesn't deposit it until January of 2026.
Doesn't matter. If the funds were made available to her without restriction in 2025, she must include it as 2025 income.
So delaying cashing a check doesn't delay the tax liability.
Not at all. In contrast, businesses often use the accrual method, where they report income when they earn it, not when they get paid. But for most of us, it's the cash method. When the check hits your hand, that's the year it counts.
We covered a tremendous amount of ground today, shifting from the nuances of relationships to the cold, hard logic of filing mandates.
We did.
To summarize the three major hurdles we cleared, remember that crucial $5,300 gross income limit for a qualifying relative. That number is everything for claiming many adult dependents.
And remember that living with someone all year is the threshold for a non-relative to count for that test, and critically, for claiming head of household status. The distinction between 6 months and 12 months can save you thousands.
And finally, never forget that bizarrely low $5 filing requirement if you choose married filing separately. It's not about revenue, it's about controlling deductions.
You know, this all raises a really important question. When you look at all those specific reasons you must file, even with low income, it highlights how the tax system often acts less as an income-based collector and more as a regulatory tool.
A tool for accessing credits and ensuring compliance with complex things like HSAs. And that leads directly to our final provocative thought for you. If your goal is to maximize your refund, the single most powerful action you can take isn't just knowing the income thresholds, it's understanding those specific must-file situations that trigger eligibility for refundable credits like the EIC and ACTC. Credits that actually put money back in your pocket.
So the question to ask yourself is this.
What specific, valuable refundable credit might you be leaving unclaimed if you decide not to file this year?
Think about that as you organize your 2025 documents. Knowing the rules means knowing your money.
We'll see you for the next deep dive.